Welcome, curious minds, to the deep dive. In a world absolutely saturated with information, especially around tech disruptors and financial markets, it just feels overwhelming sometimes, right?
Really does, just trying to keep up.
Exactly. And you start wondering, how does a company really challenge an industry as old, as entrenched as insurance? What is that whole journey, the disruption, the adapting, maybe success? What does it actually look like?
Yeah, the nuts and bolts of it.
That's what we're here for today. Think of this as your shortcut, your way to get genuinely informed with all the surprising facts, maybe unexpected twists, and the insights you actually need. Okay, so let's unpack this. Today, we're taking a deep dive into Root Inc. It's an InsurTech company, and they set out with this really audacious goal. Basically, completely redefine auto insurance.
Huge task.
Absolutely. So we're going to explore their unique approach, which is quite different. We'll analyze their recent and, frankly, pretty significant financial breakthroughs. And we'll delve into the dynamics, the competitive stuff, where they fit in this very crowded market. Now, to guide us through Root's, let's say, intricate story, we've pulled from a really rich stack of sources. We've got these in-depth analyses from experts like Matteo Carbone at the IoT Insurance Observatory, Jacob Rowe of Rogue Funds, good third-party views.
Crucial perspectives, yeah.
And we've also dug right into Root's own materials, their Q1 2024 and the very recent Q2 2025 shareholder letters. That gives us the unfiltered insights into their strategy, their performance. Plus, we've layered in comprehensive stock analyses to see how the market's perceiving them.
So the company view and the market view.
Exactly. Our mission here is to just pull out the most important nuggets of knowledge so you understand Root's journey, the big challenges they faced, and what this recent performance really signifies for them, and maybe for InsurTech overall, all without getting lost in the noise. So let's jump right in.
Right, so Root Inc., they didn't just wander into the insurance market. They charged in really with a very deliberate, almost audacious vision back in 2015.
Very intentional. Their stated aim was to completely overhaul what they frankly call the archaic car insurance industry. I mean, think about that. Taking on a sector that's been doing things pretty much the same way for, over 100 years?
It's incredibly ambitious.
Their core mission was all about using modern mobile tech, smartphones and data science to make insurance fairer, more personalized and just, easier for the consumer.
Yeah.
Seamless. It was a bold promise right from day one.
It really was a revolutionary stance. And what's particularly interesting here is how Root's approach was just a direct head-on challenge to these really ingrained industry practices.
The status quo.
Exactly. Traditionally, insurers lean heavily on broad demographic data, stuff like your credit score, your age, marital status, even just where you live, your zip code.
Right. Factors that aren't about your driving.
Precisely. These factors, yeah, they're statistically predictive to some extent, but they often meant good drivers got penalized just for being in a certain group. Root basically came in and said, look, we can do better than this. We have to. They've explicitly claimed they've never used factors like, say, education or occupation in their pricing, and they've publicly committed to trying to eliminate even more of these traditional, often criticized factors as their tech gets better.
That's a huge difference.
It's a powerful differentiation in an industry that often feels like a black box.
Yeah, it's like the old way is, okay, you fit this profile, here's your risk box, here's your rate, take it or leave it.
Kind of blunt.
But Root flips that script. They're saying, no, we're going to look at you, the individual driver, how you actually behave behind the wheel, not just some statistic. It's moving from group average to individual accountability.
And that resonates. People feel they're being judged more fairly. #1.2 telematics is the core differentiator.
Okay, now this is where Root really stands out and where it gets genuinely interesting. The absolute cornerstone of their whole operation, their pricing model, is this proprietary telematics system.
Right.
For anyone listening who isn't totally sure, what is telematics in this context, and how did Root implement it in such a, game-changing way?
Sure. Telematics, basically, it's technology that collects and sends data about driving habits and how a vehicle is used.
Okay.
So this covers a lot. Location, mileage, speed, instances of hard braking, sudden acceleration, sharp turns, maybe even things like driving late at night.
All this stuff that indicates risk.
Exactly. Root's specific approach, their kind of genius stroke, was using a smartphone app for this, not a separate device you plug in, usually.
Leveraging the tech everyone already has.
Precisely. This app uses some pretty sophisticated machine learning algorithms. It analyzes location and motion data straight from your phone's sensors. And what's really clever is its intelligence. It's designed to figure out pretty accurately if you're the one driving, or if you're just a passenger, or maybe even on a bus.
That's crucial. Otherwise, the data's messy.
It's absolutely crucial. It ensures the data is relevant to your individual driving.
So I download the app as a potential customer, and it just starts watching how I drive, learning my patterns. How does that turn into an actual policy?
It leads to what they call the test drive period.
Yeah.
The length varies, maybe a few weeks, could be up to 6 months sometimes. Depends how much you drive.
Okay, needs enough data.
Needs enough data. And during this time, the app is meticulously measuring those behaviors we talked about.
Sorry.
Are you braking smoothly, taking turns gently, staying focused, not fiddling with your phone? All this very detailed info gets crunched by Root's algorithms to calculate an individual driving score. And here's the key thing, the real differentiator. This personalized score becomes the primary factor in your final insurance rate.
Primarily based on how you actually drive.
That's the promise. It puts your demonstrated behavior front and center.
That sounds like a massive data advantage building up over time. If your whole model is based on analyzing real driving, the more data, the better your models must get, right?
Exactly. These algorithms, they're constantly being refined. They're foundational to Root's underwriting performance, and they're meant to create this durable competitive advantage. Hard to replicate quickly.
And the scale. How much data are we talking?
The scale is pretty impressive. They mention nearly 15 million app downloads, and get this, over 30 billion miles of driving data collected.
Wow, 30 billion.
Yeah, think about that. It's an immense growing asset for refining their models, making them more predictive, more accurate at identifying real risk. It lets them understand driving behavior at a depth traditional insurers just can't match.
So the example would be like a young driver.
Right, exactly. A new young driver, traditionally they get hit with huge premiums just because of their age group.
Yeah.
With Root, if that young person actually drives safely or responsibly, they could potentially get a much fairer rate because the system sees their actual habits, not just the demographic box. That link between behavior and cost is powerful. Hashtag 1.3, the good driver, value proposition versus pragmatism.
Which leads us right to Root's core value proposition.
Yeah.
This idea that, hey, better, safer drivers just deserve better rates.
Yeah.
Lower rates.
Simple and compelling.
Yeah. They've marketed this aggressively, promising big savings, up to $900, maybe 52% a year, they say, because they only insure safe drivers and pass the savings on. Sounds amazing if you think you're a good driver.
And it is a very attractive message, no doubt, clearly differentiates them. But, if we connect this to the bigger picture, the realities of the insurance world, there's an important layer of nuance here.
Okay, what's the catch or the fine print?
Well, not exactly a catch, but while the marketing emphasizes rates are primarily based on your actual driving, their own help docs, their filings, they acknowledge they still consider several standard factors that are mathematically predictive of risk or fraud.
So they haven't completely thrown out the old playbook.
Exactly. They haven't entirely abandoned those foundational risk management principles. In fact, they explicitly say ignoring these other factors would be, quote, irresponsible from a business stability regulatory standpoint.
So it's not pure disruption then. It's more like a pragmatic compromise, a hybrid model maybe?
Precisely. Pragmatic compromise is a great way to put it. This is where that revolutionary vision bumps up against the reality of a heavily regulated industry.
Right.
It highlights this critical tension.
Right.
How do you keep that brand promise fairer insurance based on your driving when, out of necessity, you still have to use some of those traditional factors you wanted to replace?
Yeah, that's tricky.
It shows that true disruption in regulated fields often isn't a clean break. It's more strategic, maybe incremental evolution. Root's journey shows even innovators have to follow fundamental risk rules. It suggests that maybe telematics alone can't capture every aspect of rig or fraud potential just yet.
Root's initial vision wasn't just about how they priced insurance. It was also very much about the customer experience. This app-first journey, totally digital, seamless. Walk us through what that actually felt like for a customer.
Yeah, especially early on, that journey was meticulously designed to live entirely on your smartphone. It started with that test drive, the app watching your habits. Once you were insured, the app was your command center for everything, managing coverage, changing deductibles, adding drivers or cars.
All in the app.
All in the app. And even filing a claim. They claimed you could do it in as little as 3 minutes.
3 minutes. Compared to the usual hassle.
Exactly. Compared to paperwork, long phone calls, it's incredibly fast and efficient. It really spoke to that modern consumer wanting instant on-demand service.
That sounds incredibly smooth. Totally aligns with what people expect now, right?
Yeah.
Manage everything from your phone. Who wants to call an agent or fill out forms?
Right. It's a compelling vision.
But are there downsides? Does that pure app-first, no-agent approach leave some people behind? Or make complex claims harder?
That's a really sharp question. It hits a core tension in many digital-first
Oh.
models. Yes, while it's built for efficiency, cutting out agent costs, physical offices, it does inherently lose that personal touch.
Which some people still value.
Absolutely. Especially maybe less tech-savvy folks or people dealing with really complex, stressful claims. Root does offer phone and email support, but no local agent network is a distinct feature. It appeals strongly to, say, younger digital natives.
Maybe not everyone.
Right. It might be a barrier for others. It's a specific vision, but one that's had to evolve as Root aimed for broader reach.
Right.
Which leads us right into their next strategic move. Hashtag 2.2, diversifying customer acquisition.
Yeah, great segue. So that initial app-first, direct-to-consumer model, mostly using performance marketing. That was their start. But it seems like recently they've made a pretty big strategic pivot in how they get customers. What drove that? And what are these new ways they're trying to grow?
That's right, and the pivot is really telling. Root's Q2 2025 shareholder letter pointed to a growing issue. Just more competition in that direct channel.
Getting crowded.
Exactly. More competition meant they actually pulled back a bit on marketing spend there. It signals that acquiring customers directly was getting less efficient, maybe less sustainable purely on its own.
Makes sense.
So that pressure seems to be the main catalyst for this big strategic shift toward diversifying how they find customers. It's like acknowledging the realities of scaling up, moving beyond just being the disruptor to being a more pragmatic player. And we've seen two major new avenues open up, really changing their go-to-market strategy. First, back in April 2025, they announced this really strategic partnership with Hyundai Capital America, or HCA.
Okay, the car finance company.
Right. This is a big deal. They're aiming to seamlessly integrate auto finance and insurance solutions right when someone's buying a car. Imagine you're at the dealership getting a new Hyundai.
And bam, there's a Root quote option right there.
Exactly. Maybe even bundled into the financing. It removes friction, hits customers at the perfect moment they're thinking about insurance. Super efficient way to reach receptive customers. Then, the second one, arguably even more significant, happened just this August 2025. They integrated with Easy Links and PL Rating.
Those sound like industry tools.
They're huge industry tools, two of the biggest comparative raters out there. Basically, software platforms that thousands of independent insurance agents use every day to get quotes from multiple carriers for their clients.
Whoa, so opening up to traditional agents.
Yes, it's a massive move. It instantly puts Root's data-driven pricing in front of this vast, established network of independent agents. That channel is known for being incredibly resilient. Agents have trusted relationships, broad reach.
Especially in a fragmented market like auto insurance.
Totally. Root's currently appointed with about 4% of these agents. Sounds small, maybe, but given how many agents there are, it's a really meaningful growth opportunity. They said they've seen strong early results in over 20 states already and plan to expand across their whole geographic footprint by year-end.
That feels monumental. It's
Yeah.
like they're saying, okay, the pure disruption app-first thing is great, but it has limits for truly massive scale.
You nailed it.
They're leaning into the established, resilient channels now.
Exactly. This pragmatic evolution from pure disruptor bypassing channels to a hybrid participant embracing them, it just underscores the realities of scaling in insurance.
Yeah.
It shows their core tech is strong, but they need traditional distribution too to really achieve broad reach and growth. It connects the dots between their innovative tech and the practical needs of expansion. They're moving from idealists to pragmatists, often necessary to survive and thrive.
Okay, so we've seen the strategic pivots, the operational shifts. The big question always is, how did this translate financially? Especially given that history of, growth at all costs. Their early years sounded pretty typical for a high-growth insurtech, right?
Absolutely typical and often a very challenging path. For Root, that early phase meant aggressively going after market share, getting customers, way more than focusing on immediate profit.
Right. Burn cash to grow fast.
Exactly. So you saw rapid revenue growth, which looked great on the surface, but almost always paired with significant net losses. They were investing heavily in building that proprietary tech, refining the data science, and pouring money into marketing to get the word out.
Makes sense. Got an example?
Sure, like the first 6 months of 2020, they reported $245.4 million in revenue, impressive growth. But at the same time, a net loss of $144.5 million. Big loss.
Wow.
And that pattern, high investment, consistent losses, continued right through their IPO in October 2020. Stock priced at $27 then. Understanding that history, that period of heavy spending and losses, is absolutely crucial to grasp why their recent results are such a big deal. It frames the turning point.
And those recent results are really what put Root back on the map, changed the narrative. We saw some positive signs, I think, in Q1 2024. Positive adjusted EBITDA, operating income,
Encouraging stuff.
early positive indicators.
But it was Q2 2025 that really felt like the pivotal, maybe game-changing moment for them, wasn't it?
It certainly was. Q2 2025 was a genuine landmark quarter for Root. They proudly marked their first ever GAAP profitable quarter.
GAAP profitable. Explain that quickly.
Sure. GAAP is generally accepted accounting principles. The standard, strict rules for financial reporting in the U.S., hitting profitability under GAAP is a major validation. It shows real financial discipline, that the underlying business model works. It's not just some adjusted metric, it's the real deal.
A fundamental shift then. Absolutely. Let's break down those Q2 2025 numbers. They really paint a picture. Their gross earned premium hit a record $371 million. That's up 21% year over year. So strong growth continues.
Okay.
More impressively, net income was $22 million. That's a huge swing, a $30 million improvement from an $8 million loss in Q2 last year.
Wow. Loss to profit. That's the headline.
That's the big one. Operating income also climbed to $27 million, a $24 million jump year over year. That looks at core business profit. Adjusted EBITDA also jumped nicely to $38 million, up $26 million, often seen as a proxy for cash flow.
And are they still adding customers?
Yep. Policies in force grew 12% year over year to over 455,000. So it's profit and growth. Now, Root attributes these strong results directly to their tech maturing, their data science getting really precise, and critically rolling out a new pricing model.
Oh, okay.
This new model is apparently much better at risk selection, picking the right drivers, and it's increasing estimated customer lifetime value by an average of 20%, sometimes more in certain states.
So the core idea is finally paying off.
Exactly. It indicates their whole thesis that better data leads to better underwriting and financials is finally showing up tangibly on the balance sheet. It's not just theory anymore.
That's huge validation.
Yeah.
Now, one really fascinating part of Root's story is their journey with the loss ratio. I heard someone say Root initially, sucked at producing a quality loss ratio. It took them maybe 8 years to really get the data working right. That sounds like a long, hard slog. What does that battle and where they are now with loss ratio tell us?
That observation is spot on. It highlights just how hard it is and how long it takes to truly master underwriting using new data like telematics.
Right.
For folks listening, a low and improving loss ratio is maybe the single best indicator of profitable insurance underwriting. It's basically the percentage of premium dollars paid out for claims.
Lower is the better.
Much better. Root's Q2 2025 gross loss ratio was 58.0%, and importantly, their gross accident period loss ratio was 59.7%. That accident period number is key. It looks at losses from claims that happened during that quarter whenever they were reported. It gives a really clear, real-time picture of underwriting effectiveness right now.
The 58%, 59.6%. How good is that really?
It's excellent. To put it in perspective, among the top 25 auto insurers, consistently getting below maybe 65-70% is considered really strong. Root is running well below their own long-term target of 60-65% and significantly better than many huge established players.
Wow.
It's a monumental achievement. It means for every dollar they collect, only about 58 cents goes out for claims. That gives them a big buffer.
For what?
A buffer to absorb shocks, like rising repair costs, more claims from weird weather, maybe even new tariffs, without having to immediately jack up rates or kill their profitability. It's powerful proof their data models work now after years of refinement. They're not just improved, they're a leader on this metric. Hashtag 3.3, the nuance of sustainable profitability.
Okay, so what does this all mean going forward? First ever GAAP profit, huge milestone, massive accomplishment. But is this it? Is Root now just consistently profitable out of the woods? Yeah. Or is there more nuance?
That's the critical question, right? And this is where we need to look closely at what Root themselves are saying, their strategy. While Q2 2025 profit is undeniably significant, a huge proof point, Root views it more as a strategic demonstration of their unit economics. Meaning not necessarily a sign they'll stay GAAP profitable every single quarter right now. They explicitly said in their shareholder letter they will continue to invest in the back half of 2025 in our business, technology, and growth, which will impact our near-term net income profitability.
So they're choosing to reinvest heavily knowing it might push them back into lost territory, at least on a gap basis near term.
That seems bold right after hitting profit.
It is bold. It's a very strategic decision. They're consciously choosing long-term growth, expanding market share, improving tech, over showing immediate sustained gap profit every single quarter.
What's the thinking there? The thinking is by reinvesting now in those new agent channels, the HCA partnership, better tech, they can build a bigger, stronger, more defensible, and ultimately more sustainably profitable business down the road.
Okay, playing the long game.
Exactly. So for investors, it means maybe don't value Root on a simple price to earnings ratio right now because they're choosing to reinvest potential earnings. The focus shifts to, can they scale up effectively, grow profitably over time without falling back into uncontrolled losses? It's a different way to look at their health, focused on smart growth, not just quarterly net income. And just a bit more financial context, they expect about a $16–18 million non-cash expense in Q3 2025. It's tied to their Carvana warrant structure.
Okay.
Basically an accounting thing linked to hitting milestones for policies sold through Carvana. Root calls it a high-quality expense because it comes from successful growth via that partnership, not from operational problems.
Yep.
And importantly, they finished Q2 with $314 million in unencumbered capital. That's a healthy cushion, gives them flexibility to invest and execute without needing to raise more money right away. Breathing room for the long game.
Right, Root isn't doing this in a bubble. It's part of this whole insurtech movement. But they're also up against some absolute giants, the established players with deep pockets, huge brand names. How does Root actually fit into this super crowded competitive space, both against peers and the big guys?
That's crucial context. No company operates alone, especially not in insurance. Root often gets mentioned alongside other big insurtech names like Lemonade, Oscar Health, Haggerty.
Right, all using tech to disrupt different bits of insurance.
Exactly. Lemonade and renters, home, now expanding into car, Oscar and health. But what really sets Root apart is its almost single-minded focus on auto insurance and using that smartphone telematics as the core pricing and risk tool. That's their unique angle, their main thesis.
That distinct focus.
Oh, and just a quick clarification for anyone looking at tickers. There's an apparel company called Roots on the Toronto Stock Exchange, TSX, Root. We're talking about Root Inc., the Insurtech, NASDAQ.
Right.
Root, same ticker, different company, different country.
Good clarification. Avoids confusion. Hashtag 4.2. Traditional insurers' telematics response.
Yeah.
Okay, connecting this to the bigger picture. Root might have pioneered this telematics first thing, but the big traditional insurers, they haven't just been sitting back watching, right? They've rolled out their own telematics programs. Try and neutralize Root's advantage.
They absolutely have. And this creates significant, constant competitive pressure for Root. It's the classic incumbent response to disruption. Let's look at a couple of big examples. First, Progressive Snapshot. It's optional, usually for existing customers. Uses an app or a little plug-in device to watch driving.
Okay.
They advertise average savings, maybe $130, give you $25 just for signing up. But here's the key. Risky driving can actually lead to a rate increase at renewal. So it's a real underwriting tool for them, not just marketing fluff.
Got it. It bites back, potentially.
It can. Then there's Allstate DriveWise. Similar idea, mostly uses a mobile app, rewards safe driving with discounts. They offer things like 3% cash back for signing up. And one report said DriveWise customers were 25% less likely to have a serious crash, which suggests it works in managing risk.
So the big guys are definitely using telematics effectively too. But what's the fundamental difference between their programs and Root's whole model? Seems subtle but important.
It's a very important distinction. It gets to the heart of Root's unique position. Root is a pure-play telematics insurer. For them, that app data isn't just a factor, it's the primary rating mechanism. Often, it's a gate. If you don't use the app or your driving doesn't meet their safety threshold, you probably won't get a policy, or at least not a good rate.
So their customer base is inherently pre-screened for low risk.
Exactly. In stark contrast, Progressive and Allstate offer telematics as a tool to attract and keep good drivers within their already huge, diversified risk pools.
Ah, okay. It's an add-on for them, not the foundation.
Precisely. They can afford to insure a much wider range of drivers, good, average, even some higher risk because their massive scale lets them balance risk across millions of policies. They use telematics to reward their best drivers, but it's not the only way in or the whole basis of their business. And this dynamic puts huge pressure on Root. A good driver that Root wants might get a similar discount from Progressive or Allstate, who also have brand recognition, maybe bundled home insurance.
Right, more offerings?
So this competitive pressure really helps explain Root's pivot to new channels like agents and HCA. The big guy's ability to absorb all kinds of drivers and offer telematics discounts is a major threat to a specialist like Root. They're competing on tech, yes, but also on reach, brand, and overall risk management scale. Hashtag TAG5, investor sentiment and future outlook.
Okay, let's shift to the market's view. How has Wall Street reacted to Root's journey? Since the IPO, their stock's been,
Oh, right.
well, a roller coaster seems like an understatement. Pretty extreme volatility.
Oh, it's been truly tumultuous. A wild ride for investors since that October 2020 IPO. The stock has seen just incredible swings, reflects both that early hype for insurtech disruption and then the harsh realities of scaling a business like this.
Give her some numbers.
We've seen a 52-week low of $34.04 and a high of $181.14. That's a massive range.
Huge swing.
Market cap around $1.41 billion currently. And it has a very high beta, 2.25, meaning it's theoretically much more volatile than the overall market. A 1% market move could mean a 2.25% move for Root, up or down.
Wow.
We saw that volatility clearly in Q1 2024. Stock surged to over 20% at $85 after good earnings, then gave it all back pretty quickly.
Yikes.
And there are these other factors, business-neutral catalysts, that can move the stock price regardless of how the company's doing. Like, it has a relatively low float, only 64% of shares available to trade. Combine that with 17% short interest, lots of bets against it, and you could potentially get a short squeeze.
Where short sellers have to buy back, driving the price up fast.
Exactly. Plus, Root joined the Russell 2000 index in June. That often boosts institutional buying as index funds have to add the stock. So lots of moving parts beyond just earnings.
Which brings us to this really fascinating paradox, something any investor would want to figure out. Despite Root hitting that huge milestone, GAAP profitability, the analyst consensus from 17 analysts is still just hold, cautious.
Yeah, not exactly a roaring buy.
And maybe even weirder, the price targets are all over the place, from like $51 up to $165, average around $160. That signals a lot of uncertainty, division among the pros. What's driving that, especially when you look at who's actually buying and selling?
This raises a really important question. It's a classic case of conflicting market signals, very confusing for investors. Over the last 6 months, we've seen this consistent and frankly somewhat concerning pattern. Lots of high-value insider selling and almost no insider buying.
Insiders meaning?
Directors, executives, people with the most intimate real-time knowledge. For example, a director, Meyer Malka, sold about 225,000 shares for roughly $30.5 million. The CEO, Alexander Tim, sold around $2.1 million worth.
That's not usually seen as a great sign, right?
Often, no. Consistent insider selling can suggest they don't see huge upside from current levels, or maybe just want to diversify after a volatile run. It doesn't always mean bad news, but it's a data point. But then you look at institutional ownership, big money managers, pension funds, etc., and there it's a net positive inflow. We've seen 143 institutions adding shares, while only 85 cut back.
So the big funds are buying what the insiders are selling.
To some extent, yes. Large, well-known firms like Insun Peak Advisors, T. Rowe Price, they've significantly increased their stakes. That signals belief in the turnaround, the long-term potential.
Okay, that is a confusing picture. Insiders selling, institutions buying. What's the takeaway?
It creates this really complex, contradictory signal. Internal perspective seems cautious, or maybe just taking profits. External, sophisticated investors seem optimistic. This split is pretty rare and makes it a really interesting investment puzzle. You have fundamental strengths, like the Q2 profit, weighed against this internal selling pressure. Hashtag 5.3, risks and opportunities ahead.
Okay, so given all this complexity, the strong Q2, the pivots, the competition, these conflicting investor signals, what are the main risks and opportunities shaping Root's future? What should listeners keep an eye on?
It's definitely a mixed bag. On the risk side, intense competition is huge, both from legacy giants adapting with their own telematics and other insurtechs fighting for the same customer.
Constant battle.
The general market mood, that risk-off feeling towards tech companies that aren't consistently profitable, that's still a headwind for valuation. Operationally, rolling out nationally, dealing with 50 different sets of state regulations, that's complex and expensive.
Yeah, insurance regulation is notoriously tricky.
It really is. And finally, while their auto models seem strong now, accurately pricing their other products like renter's insurance. That can be harder. They don't have the same granular driving data for those lines.
Right, different underwriting challenge.
But there are also significant key opportunities. Those strategic partnerships, HCA, the independent agent platforms like EasyLinker's PL Rating, those are massive new avenues for customer acquisition, potentially much cheaper than direct marketing and reaches way more people.
Tapping into existing networks.
Exactly. They also have more product filings pending in various states. If those get approved, that unlocks new growth markets. And don't forget that data asset, 30 billion miles plus, could they leverage that for things beyond insurance someday? Driver safety tools, smart city data, who knows?
Interesting potential there.
And ultimately, their stated goal is huge. Build the largest, most profitable personal lines insurer in the U.S. That's the ambition. So putting it all together, Root's at a critical inflection point. They've shown their tech can lead to profit. But long-term success really hinges on navigating the competition, making these new channels work profitably, and proving Q2 wasn't just a one-off.
A sustainable trend, not just a blip.
Exactly. The path ahead is still complex, still risky. But they've undeniably shown they have the tech and the strategic flexibility to potentially make a really big impact on auto insurance. Hashtag tag tag outro.
Wow, what an incredible deep dive into the Root Inc. story. We've tracked that initial, really audacious vision to revolutionize auto insurance, followed the pragmatic evolution as they adapted to the market, celebrated that huge Q2 financial breakthrough at the first GAAP profit.
A major milestone.
Absolutely. And we unpacked that complex, sometimes contradictory competitive and investor landscape they're navigating. It's just a powerful look at how challenging it is to truly innovate in such a traditional industry. So what can we as listeners really take away from Root's story? About innovation in general, I think it's a really compelling example of balancing that disruptive vision with market realities, competition, and the long, hard road to actually achieving sustainable profit.
Yeah, the grit required.
Totally. It shows the adaptation, the compromises needed. Disruption is rarely just a straight line, is it?
Not at all. And maybe a final thought to leave folks with. Given those complex signals, insiders selling, institutions buying, and Root explicitly saying they'll reinvest heavily, impacting near-term GAAP profit, how much weight should we actually give that single profitable quarter as a sign of long-term sustainable success for an insurtech like this?
That's a great question. How much does one data point matter versus the stated future strategy? Excellent food for thought.
Definitely something to ponder.
An excellent thought-provoking point as Root's story keeps unfolding. So keep an eye on Root Inc. NASDAQ Root.
Their journey is clearly far from over, and it's unfolding in really fascinating ways. Thank you so much for joining us on this deep dive.
My pleasure. We'll catch you next time.